Hey Iguana fam, don't chase yield. In a new rate cycle, high yield can be a trap. If DPU looks flat now, that may hide very different balance sheet paths. Today I'll show a simple 5-factor score to find REITs that can keep paying through the 26 refinancing hump, adapted from my latest in-depth Substack deep dive. I'm Iggy from the Investing Iguana, Singapore-based market analyst. I break complex ideas into clear, usable playbooks for CPF and SRS investors. Here's today's flow. Setting the scene. Why surface numbers aren't enough. The 5-factor REIT score for 2025. The anchor archetype, defensive core. The growth pick, rental reversion engine. The disruptor, uncorrelated income with FX keys, position sizing, and risk controls for SG investors. Stick around for the DPU sensitivity boxes and a clean allocation template. If yield alone worked, we'd all be rich. But after the rate spike, REITs are not equal. Many face big maturities into 2026. Some hedged, some didn't. DPUs may look flat, yet the risk trend can be up or down. In this video, you'll get a repeatable checklist to screen REITs by debt, coverage, refinancing, and tenant strength. Then we apply it to 3 archetypes: anchor, growth, disruptor, so it's easy to build a balanced SG income sleeve. Adapted from my latest Substack deep dive. I'm Iggy. I run the Investing Iguana, focused on Singapore markets, REITs, and portfolio frameworks for CPF/SRS. Chapters follow the article's sections in order. If you want the full tables, checklists, and the written playbook, grab the Substack post. Link is in the description. Singapore's REIT landscape now. Rate shock to normalization. Rates surged into 2023-2024. That hit DPUs and pushed leverage up. In 2025, funding costs started easing, but relief lands with a lag. Why? REITs refinancing badges. The headline rate isn't the whole story. The schedule of maturities matters more. Think of it like MRT train intervals. You catch the train when it comes, not when you reach the platform. REITs get cheaper debt only when their old loans roll. Fixed rate shielding and dispersion. Many REITs now have more debt fixed at stable rates. That's a safety umbrella. But umbrellas differ. If a REIT hedged 80%, it stays dry longer. If it hedged 55-60%, it gets wet faster when rain returns. Same weather, very different outcomes. That's why fixed rate percentage and hedge duration are key. Valuation gaps, price to book ratios are still wide. Some strong names trade below book. Others look cheap, but carry stretched balance sheets. A discount can be value or a warning. The 5-factor score separates a bargain from a trap. Are you buying the yield or the cash flow engine that makes the yield? Quick verbal table summary, sector snapshot. Since 2023, funding costs jumped, then eased stepwise. Fixed rate protection improved. DPUs stabilized but need time. Valuations saw selective recovery. The investor implication: read the refinancing ladder and fixed rate insulation before judging yield durability. The 5-factor REIT score for 2025. Here's the rules-based lens. Score each factor from 1, weak, to 5, strong. Aggregate leverage. Watch anything creeping above 43%. Stress shows before the regulatory cap. Lower is safer. Fixed rate debt percent. Aim for 75% or more. Below 60% invites rate shocks. ICR headroom, interest coverage ratio. Minimum is 1.5x. Healthy is 2.0 to 3.5x and above. Refinancing ladder, 12 to 24 months. Smooth is good. A cliff is bad. Asset recycling and tenant health. Are managers selling weaker assets, buying stronger ones, and securing resilient tenants? Think of it like a car. Leverage is vehicle weight. Fixed rate debt is the seatbelt. ICR is braking power. The refi ladder is traffic flow ahead. Tenant health is engine reliability. You want a car that stops fast, drives light, and sees clear road ahead. Verbal table summary of the scoring guide. Leverage, 38% is strong. Fixed rate, sector sin is 5% is strong. ICR 3.0x is strong. 20% of debt due by 26 is strong. Diversified tenants with active recycling is strong. The beauty. This removes headline yield bias and keeps decisions consistent. The anchor. Defensive core, steady growth. Profile, large, diversified, Singapore heavy, strong sponsor, high tenant retention. This is the bedrock of an income sleeve. 5-factor scorecard. Example, anchor archetype. Aggregate leverage, around 38 to 39%, below risk zone. Fixed debt, about 75-80%, solid insulation. ICR, about 3.0x, healthy buffer. Refi schedule, backloaded maturities, no cliff. Asset lot tenant, 96% occupancy, diversified mix, ongoing asset recycling. Why this matters? Below 40% leverage gives room to maneuver. High fixed rate debt smooths cash flow. ICR near 3x absorbs shocks. A backloaded ladder avoids cluster pain. High occupancy keeps rent cash steady. This is CPF SRS friendly. DPU sensitivity box, anchor, plus 50 BPS funding cost, about 3% DPU, 50 BPS funding cost, about plus 2.5% DPU, 100 BPS occupancy, about 1.2% DPU, 100 BPS occupancy, about 2% DPU, FX, minimal for SG-centric portfolios. So, rates still matter. But with buffers, small swings don't kill payouts. Occupancy moves nudge DPUs, but don't derail. That's why Anchor works well for CPF and for the sleep well part of SRS. What would make me wrong? A large tenant exits and vacancy spikes. A surprise rate jump stays elevated long. Asset values fall and shrink debt headroom. Anchors are not risk-free. Watch ICR trend, valuations, and tenancy renewals. Verbal table summary. Why Anchor is core. Leverage 36 to 40%, fixed 75 to 85%, ICR issues 3.0x, occupancy at 96%, recycling ongoing. It's reliable and flexible. If CPF is for stability, why hold a core that behaves like a roller coaster? That's the safety layer. Now let's add some pace without losing control. The growth pick, riding positive rental reversions. Profile, focused on segments with rental upside, suburban retail, selected offices. Asset enhancements, AEIs, and tenant remix drive organic growth. 5-factor scorecard, example, growth archetype, aggregate leverage, about 39% controlled, fixed debt, about 60 to 65%, watch the refi windows. ICR, about 3.5x, strong, refi ladder, manageable, smooth through 2026. Asset or tenant, 98% occupancy, essential trade mix. The story, growth needs execution. Lower fixed rate protection than Anchor means timing matters. But strong ICR and high occupancy bridge the gap until AEIs and reversions kick in. DPU sensitivity box, growth, plus 50 BPS. Funding cost, about 2% DPU, 50 BPS funding cost, about plus 2% DPU, plus 100 BPS occupancy, about 0.8% DPU, 100 BPS occupancy, about 0.9% DPU, FX, modest unless overseas share rises. This is a flywheel. Get projects done on time, capture reversions and DPU ramps. The risk is delay or consumer softness. Verbal table summary. Reversion and AEI path. Releasing drives. Rent up. AEIs add NPI. Refi needs careful timing. Mitigants. Essential trade mix. Phase projects. Opportunistic terming. If suburban malls keep footfall and AEIs land, do you have enough growth in SRS to lift returns? So we've got a core and an engine. Now let's add a stabilizer that doesn't move with the same cycle. The Disruptor. Defensive yield. Uncorrelated play. Profile. Niche sectors with low correlation to the SG cycle, like healthcare. Income often locked by master leases with step-ups. FX hedging is vital. 5-factor scorecard. Example, Disruptor archetype. Aggregate leverage, around 36%, conservative. Fixed debt, about 85-90%, sector leading. ICR, 4.0x, wide buffer. Refi ladder, well-spaced. Assets by tenant, 100% occupancy, long leases, escalations. It's armor-plated. High fixed rate share and long leases protect DPUs. The swing factor is FX for overseas income streams. With disciplined hedging, payout volatility stays modest. DPU sensitivity box, Disruptor, plus 50 BPS funding cost, about 2% DPU, 50 BPS funding cost, about plus 1.5% DPU, FX, 2%, about 3.1% DPU, FX plus 2%, about what's 3.1% DPU, occupancy, stable under master leases. So occupancy risk is small. Currency risk is the main variable. Verbal table summary, FX and lease mechanics. A plus 2% FX move can shift DPU by 3.1%. Step-ups add growth. High fixed debt reduces refi shocks. Key control is rolling hedges. If the SGD strengthens, have you checked how much of your healthcare income is hedged and for how long? We've covered the three roles: core safety, growth engine, and uncorrelated stabilizer. Let's put them together for CPF and SRS. Position sizing and risk controls, the smart SG income sleeve. Portfolio guidance, anchor, core, 50%, ideal for CPF SRS. Low volatility, steady DPU. Growth, satellite, 30%, focus on clear rental reversions and on-time AEIs. Disruptor, high potential, 20%. Niche stability with effects awareness, use SRS or keep sizing tight. Why this mix? Anchors stabilize cash flow. Growth drives upside. Disruptors diversify the cycle and add resilience. Keep Disruptor capped if FX or policy risk worries you. Downgrade triggers. ICR trending below 2.0x or leverage above 43%. Refinancing surprises that raise costs above plan. Occupancy falling more than 5 percentage points. Major tenant distress or sponsor governance issues. Put rules in writing. When a line breaks, act, trim, or rotate. This beats hope. It also guards CPF/SRS capital. Verbal table summary. Example allocation and controls. The 50-30-20 template with key watches and exit triggers for each archetype. DPU sensitivity. Archetype summary. Rate up plus 50 BPS. Anchor 3.0%. Growth 2.0%. Disruptor 2.0%. Rate down 50 PPS. Anchor 2.5%. Growth 2.0%. Disruptor 1.5%. Occupancy below 100 BPS. Anchor 1.2%. Growth 0.8%. Disruptor flat. Occupancy 100 BPS. Anchor 2.0%. Growth 0.9%. Disruptor flat. FX plus 2%. Minimal for anchor, modest for growth, 3.1% for disruptor. Investor fit. CPF and SRS. Angle. Risk averse. CPF heavy anchor. SRS modest growth. Accumulator. Balanced CPF. Higher growth in SRS. Yield hunter. Some anchor. Higher disruptor in SRS. But manage FX and drawdowns. My base case. Use the 5-factor score to screen first. Then allocate 50-30-20. For CPF. Prioritize anchors with strong fixed rate cover and ICR 3x. For SRS, dial growth if reversions and AEIs are visible and funded. Add a measured disruptor sleeve for uncorrelated cash flow, only if FX hedges are clear and rolling. Watch two things into 2026, the refinancing ladder and ICR trend. If either deteriorates, cut weight. A small yield premium is not worth balance sheet strain. Key takeaway, don't buy the label or the headline, yield. Buy the cash flow engine that can survive 2026's refi hump. Let's recap in article order. 1. Surface yields can mislead in a rate cycle. 2. The 5-factor score keeps your process tight. 3. Anchor gives stability. 4. Growth adds upside with execution. 5. Disruptor diversifies with FX controls. 6. Size at 50-30-20 and enforce hard downgrade triggers. You can take these lessons into your SG investing journey and build a steadier income sleeve for CPF and SRS. If this helped, like the video, share it with a friend, and subscribe. If this helped, like the video, share it with a friend, and subscribe. If this helped, like the video, share it